Today is the unplug version of our Zoom meeting with Mr. Joel Kishner. And let's see what we talk about. And if you have any question about it, just message me or comment below. So, Mr. Gashner is too is have a 40 years experience, like I said, in executive experience in the CIS organization. Property type runs from $1 million owner user office condominium to 5 million senior living facility, food, fast food franchise locations, hotels and high-end restaurant, multiple purpose facility and medical offices and shopping mall, shopping center, multiple family home and auto dealership, to name the few. Basically, Mr. Garcia have a lot of experience, as you can see, and it's really helping right now us to focus on helping tax professionals to help their business owners to do what we can so that they can reduce their taxes and bring and create positive cash flow in their business. So, Mr. Justner, how are you doing today?
I'm doing good, Ronald. It's great to be with you.
So, sir, like I said, you have a lot of experience and a lot of things to bring on the table. And as you can see, what is cost like in the first place?
Well, I'll try to make it simple. Whenever someone buys a commercial property, so it could be an office building, it could be a small building to house their own business, it could be something big like a hotel, it could even be a single family residence that they're going to rent out to someone else, or duplex or triplex or multifamily housing, as long as it's going to be rented out. Now, that also includes if I own a business and I decide instead of leasing space that I'm going to go ahead and buy a building, maybe I buy it personally in an LLC, a limited liability corporation, and then I lease it to my operating company that I own. Then do the same thing. And what happens is it allows when you buy a property for commercial use that you are allowed to depreciate that. And what that means is over time, the property, the value of the property is allowed to be deducted so much per year from your tax return. So what happens is if I go out and I buy a property for, let's say, $2 million, and first thing I have to do is determine what the land underneath the building is worth, because the land itself does not depreciate. So we start with $2 million, and let's say that we determine the land is worth $500,000. Land by itself, not improved. So we would deduct that $500,000, and then we have $1.5 million, which would be called our depreciable basis. And what the IRS says is that we would divide that, if it's commercial property, by 39, because that's the number of years they say that property can be depreciated over. And you would depreciate 1/39th of that every year on your tax return. And if it was a residential property, so single family or could be apartment building, it would be divided by 27.5, which is what the IRS says. So, and then you depreciate it each year as long as you own it. Now, the problem with that is when you look at that building, there are a lot of things that are maybe attached to the building that don't have a 39-year life or a 27.5-year life. What cost segregation does is it breaks that building apart into its various component parts and pieces and puts values on each of those pieces, and it categorizes them as either 5-year life, 7-year life, or on the outside of the building, the land improvements. We said the land doesn't depreciate, but the land improvements do. Land improvements are 15-year life. So instead of depreciating things like carpet, window coverings, wall coverings that have to be replaced periodically, they're not going to hold up for 39 years. So we depreciate them over more of what we consider to be a true useful life. So carpeting, 5 years, so on. That's how we do it. And so what happens is, if you can write off and depreciate more of that stuff early in your ownership, that's usually where you need to improve your cash flow. And this allows you to, you're not going to avoid taxes, but you're going to change how you pay them. And you're going to move some of that up front, which is when you need that cash flow.
Okay. So who's qualifies to use this cost seg?
Basically, anyone that is a serious real estate investor or a developer or someone that is buying property and going to hold it. If somebody's just going to buy it and flip it, then we would say don't do cost seg because you're going to give all the money back. Mm-hmm. But if you are going to hold a property for a minimum of 3 years, cost segregation really changes how that property cash flows.
And this is the way you help some of the real estate investor to first get the value of that property before they buy it. Is that the way I heard about that in one of your webinar with us?
Right. And a lot of clients that we've worked with over the years will come to us while they're negotiating to buy a property. Oh. And we will look at that property with them, and we will estimate what the tax benefits are going to look like based on how we accelerate depreciation. Because right now, the way the tax code is written, when let's say you buy that property for $2 million, we back out the land, there's $1.5 million left. If we break that down, anything that we can get into a life of 5 years, 7 years, or 15 years, you're going to be able to fully depreciate all of those items in the first year. That's what's called 100% bonus. And it has to qualify, has to be certain kinds of things. We have to break it down. But that's part of what cost seg does. So if you, in fact, need those tax benefits and you can make use of them, then it makes sense. It doesn't work for everyone, and it just depends on what your tax situation is.
And then what criteria qualifies a building to be a cost seg?
Any building that the current owner has acquired, you can technically go back all the way to 1987, but if you bought something in 1987 and you still own it, you've used up all your depreciation, right? So we look at buildings kind of 2 or 3 different ways. We look at them right when they buy them, and we accelerate from day one so they maximize their cash flow. We a lot of times will look at buildings 4 or 5 years after someone acquired them, and what that allows us to do is we look at the building and say, if we had done the study for you right when you bought it, and now we're out 5 years, how much would you have been able to take in depreciation expense over the course of the 5 years? Then we'll get that number and we'll back out what they've actually taken. And the difference, they can take all at once on the current year's tax return without having to amend any returns. So let's say, I'll give you an example. We did some apartment buildings for a big client of ours, and each one, the purchase price or depreciable basis was about $10 million. And one of them they had for 5 years, and they hadn't done cost seg. They were just doing straight line depreciation. The other 3 they had acquired in the current year. So we studied each of those. The first one that they'd had for 5 years, when we calculated how much they could have taken over that 5-year time span, and we backed out what they'd already taken, we helped them net another $500,000 of tax benefits by catching them up on the depreciation they had never taken. Because the IRS allows you to go back and do that, change your accounting method to use an alternate method, which is allowable, and it gets you to catch up, allows you to catch up on that depreciation expense. And so you could do it at the beginning, or you could do it later on, or let's say you're going to do a big renovation of a building that you've had for a number of years. You can do the study then and accelerate the cost of the renovation.
So, many people who listen to us at First Finance and always listening to our live stream, that they know that we are really focusing on medical offices, but there's another kind of other types of building that this can apply to, right? So, what can you emphasize that?
It applies on every kind of building. We do everything from fast food franchise buildings to warehouses to hotels to hospitals. Medical offices and dental offices are some of the best for cost segregation, because when you look at, if we compared a medical office building with a general office building where we had insurance agents or we had accountants, the difference is really in a medical building, in a suite, say 3,500 square feet for doctors, we have, the standard kinds of plumbing and electrical, but we also have to have more electrical to make the doctor's equipment work, because they've got a lot of equipment. They might have x-ray equipment in there where you have to have more power. If they have an MRI, you're going to have special air conditioning to cool that room. When we look at the individual doctor's offices, they have to have a hand washing station in every exam room. Now, the plumbing, typical standard plumbing, has a 39-year life. Can't really shorten it. But if it is plumbing that was there so that the doctor can actually perform his business function, so basically the health codes say he has to have a washing station to wash his hands. Now that plumbing, to make that possible, becomes a specialty item. And instead of it being 39 years like the rest of the plumbing, it's 5 years. Same thing with if they had added more electrical to make the doctor's equipment function, that electrical goes to 5 years instead of 39 years. So you've got all, and the air conditioning system, depending on what the doctor's specialty is, you may need, particularly as we're dealing with COVID and these diseases that are really spread, you may need to have more than standard air conditioning. And if we can show that that's the case, the air conditioning then goes to specialty, has a 5-year life instead of a 39-year life. So that's why medical and anything that has special equipment, it could be a manufacturing facility, and maybe they're dealing with some kind of manufacturing process and they have to use a lot of chemicals. Well, standard air conditioning system isn't going to be adequate because you need to be able to vent the chemicals out. So that all that venting equipment and the power to run the machinery is now all specialty, and it goes to 5 years. So it'll work in any kind of building. Some work better than others, like everything. Yeah. But medical is very good. Works really well.
And then as we can see, that's a lot of cash flow coming back to an owner to do the cost seg. But is this still cost seg to put me more at risk on the IRS audit because I'm getting a lot of tax coming back to me, or tax break?
No, cost segregation has been in the tax code since the 60s. It was back then, we had a couple of things. We had component depreciation, we had cost segregation. They're pretty similar. Component depreciation got wiped out with the 86 Tax Act. We had all of these different tax shelter programs that were out there. And when they wiped away a lot of those, they eliminated component depreciation. Cost segregation was still on the books. Nobody really used it until the mid-90s. And then there were two major court cases. The biggest one was Hospital Corporation of America, where they challenged the IRS and they said, look, because of the nature of our business, operating these hospitals, we're constantly cleaning the floors because we got blood spills or whatever, and germs, and everything wears out quicker. The more you clean, the quicker it's going to wear out. So we are replacing draperies, and we're replacing flooring, we're replacing a lot of these other things, window coverings, every 4 or 5 years. And they started researching the tax code, and they said, wait a minute, this is in the tax code. It allows us to do this. And big challenge in court, about a $700 million swing in favor of Hospital Corporation of America. And when they were finalizing the case, the judge said to the representative of the IRS, how come you've agreed and admitted that this is legal, that you can actually depreciate these things over these different lifetimes? How come more people don't do that? And what the response was from the IRS was, it's not our job to tell people what they can do. We just tell people what they can't do. Mm-hmm. And that was the end of the case. And that's when 1996, 97, when cost segregation started to be done by the big 4 CPA firms, and then eventually some specialty firms started developing capability, and that's where we came in. And we've been doing it, our group has been working together for about 16 years now, and we do what are called certified cost segregation studies. And two of my partners are certified by the American Society of Cost Segregation Professionals, which is the only body that tests cost segregation people and certifies the quality of the work.
Okay.
And
we're going to ask you about that.
Yeah, we're involved in that, and one of my partners actually chairs the Technical Standards Committee for the Society. So we stay on top of all of these technical things that are happening.
So can you say that I know a lot of advertisement I see in the social media right now that they're doing cost seg, but some of them are not certified. So meaning that they're not really know what's going on in the cost seg arena, and they're just doing it by themselves. And is that make more problem in the future for whoever's doing this, or even the owner who asked to do this for them?
Well, I think that I'm not saying that the people that aren't certified don't know what they're doing, but they don't go through the detail. There are a number of firms out there that will, what kind of as we call it, pick out the low-hanging fruit. They'll quickly come up with, this is what 5-year stuff is, and they're going to guesstimate the 15-year. Part of doing a cost segregation study correctly is taking a set of plans and doing a complete takeoff of the building. So it's just the opposite of how you build the building. If you were going to build a building for yourself, you'd sit down with an architect, you'd talk about what you want that building to look like and how big and so on. The architect would develop some plans. Then you'd go out to contractors and get bids for each of the specialties. So framing, electric, plumbing, there's going to be gas in it, gas distribution system, and so on. And each thing gets bid on separately. Well, when we start, we're dealing with a building that already exists. In some cases, it might be 100 years old. But we will take those plans, we'll take what the purchase price was minus the land, and we do a complete takeoff of the plans, taking every component. First of all, we'll start with systems. So we're going to figure out what the plumbing system is valued at on the day you purchase the building. We're going to do the same for the electrical system, the same for if you've got elevators, escalators, all these different things, HVAC. We're going to determine what the value is the day you bought it. Then we're going to take the system value. We're going to break each system down into subsystems and component parts. We're putting values on every part of that. Now, those are typically things that aren't going to change from 39-year to something shorter. Then, so we're going to take all the 39-year, but we're going to break it all up. Like a roof is 39-year life, unless it's on a residential building, then it's 27 and a half. But a roof may be made up of multiple component parts. So when we break down a roof, we might have 3 or 4 values, depending on what kind of construction it is. And part of the reason for that is, if you bought a building today, and maybe you had an inspection done, and they say it's in great shape, well, you start depreciating all of this stuff over 39 years, let's say. And 3 years from now, there's a problem, and you've got to replace the roof, or you've got to replace the plumbing system. If the study wasn't done properly and detailed, you can't find values for each of those systems or the subsystems because they just left that all in 39 years.
Yeah.
And so if you have the detail, the way we do it, you'd look at, if I've got to replace the roof, I'm going to look at, okay, what was the roof valued at the day we bought it? Now we can go in, we can say we've owned it for 3 years, so if we have depreciated 339s, we still have almost, 90 some odd percent of it has not been depreciated. Yeah. So if I have to tear that roof off, I can very easily determine what that value should be, and I write that off on my taxes, which helps me pay for the new roof. And then we start depreciating the new roof. Now, a lot of firms don't go down to that level. They'll just say, okay, here's the 5-year stuff, here's the 7-year stuff, here's 15. And they leave all the 39 in one lump sum. Doesn't do you any good because you're going to own that building for years. You know you're going to be replacing things. Same thing with the plumbing system, the electrical system, and what we're doing is providing you the detail. It's like a living database on your building, so that 3 years from now, 5 years from now, 10 years from now, if you've got to tear out the bathrooms, you're able to calculate what that bathroom was worth when I bought it, minus what we've depreciated, and now we write off the rest. So that's why it's not just, it's great to get the benefit of cost segregation up front, but it's something that you're going to use as long as you own your property.
Okay, so I know, Mr. Jolie, you know me, I always talk to you about this. We can talk about this all day long. But like I said, the last question I can ask you is, does the cost seg study change the overall amount of depreciation, and what changed have occurred in the tax code in the last 7 years?
Well, over the last several years, when we look at what's gone on, like the CARES Act, when the CARES Act was put in place, it used to be that if we did what we call a look-back study, so if you owned the building 5 years, we're going to go back and look at how much it could have taken, and we're going to take the difference all at once. There's 2 alternatives. You can take it all at once, use whatever you need for the current year, and if you have the leftover, you carry it forward for future years. The alternative to that was if we did a study and this wasn't a particularly good year for you and you don't owe a lot of taxes, we could go back and look at the prior 2 years. And if you paid a lot of taxes, we could apply that back to the prior 2 years' returns and get a refund. Now that required a partial amended return. The CARES Act said we're going to do one better. Instead of just being able to go back 2 years, we go back 5 years.
5 years. Oh.
So that was a change. So if, when we look at COVID, for a lot of people, 2019 wasn't a good year. So the years they paid a lot of taxes could have been in 17 or 18. So we can go back and look at that. But you are going to amend returns when you do that. But that was one of the changes. The other thing was the CARES Act allowed you to do the 100% bonus, so that you could take that big bonus up front. I'll give you another example. It doesn't just work on when you buy a building. So I have clients that bought a medical building or an old building, and they were going to convert it to a medical building. The building itself really needed to be gutted. They took it down to the studs. There wasn't much left, some framing and so on. And so what was left of it was going to be all 39 years. But they were going to spend $1.5 million to build out the building. It was about 11,000 square feet, and to make it medical offices. So on that $1.5 million, we were able to take 100% bonus depreciation on $1.1 million, which meant they depreciated $1.1 million of the $1.45 million in the first year.
Dang, that's a lot of money.
Big tax savings.
Yeah.
This is a client we've done multiple buildings for over the years. We have a lot of clients that we work with a lot of CPA firms, a lot of advisors. So some of the CPA firms we've been working with for 15, 17 years.
So it's not just out of the blue you're doing this. You've been doing this for a while, and like I said, the experience is top notch, basically. And hopefully our guests, our televiewers right now, or our audience right now, can see how good is our specialist. It's not just we need a cost segregation, or we need to save taxes. Oh, we're gonna call Mr. Joel today, and then we're gonna have a conversation with them. No, we know Mr. Joel for many years now. Since I started with the Elite Resources team, I know him is always, even though he is always, I know he's always busy. He's always on the go. But every time we have a question about this topic, he always open to us and telling us what the good approach to help not only our tax professional partners, but especially our business owners. So if you have a question for Mr. Gerstner, just contact our office, cursefinance.co. Basically, we will ask your question to him, so that if you are thinking about cost seg, or thinking about something that you can use to reduce your taxes, and then or create a positive cash flow in your business, maybe this is a strategy for you. So for the last statement, or last advice, Mr. Joel Gassner, what is that for your tax professional and business owners?
Well, I would just say that if you're serious about real estate investing, or there's another interesting thing we talked about. If I buy a building, then I'm going to lease it to my own company. That there's something in the tax code that a lot of people forget about, and you are allowed to group the two entities for tax purposes, which means you don't have to worry about any passive loss issues. So it's just something to think about. So, we get brought into a lot of situations by bankers that are underwriting loans, because most banks don't take into consideration the depreciation expense and how that changes the cash flow. So it really, as you're financing and looking at that, cost segregation can really impact how well a loan works, and it could impact the rate.
All right. So as you can see, And thank you, Mr. Joel Gaster. I really appreciate your help and appreciate your knowledge, especially 40 years of knowledge. That's you cannot just get that in a book, right? Or you cannot just get.
I'm really old. That's all.
Yeah, yeah, yeah. No. I mean, like I said, you are always open to us. You're always open to discussion, and this we really like about you is you are very transparent about your work, and that's really I like, especially when I talk to you, and really thank you for your time today.
My pleasure. At one point, we do work all over the country, so we're not limited to Southern California. We do work. In fact, we've done work outside of the country as well, as long as the building is going to go on a U.S. tax return.
Okay, here we go. So another daily dose of knowledge from Pure Finance, and have a nice day. All right. So hopefully, you guys learned a lot of things for our topic for today. Cost segregation has a lot of things that you can do. There's only one strategy that we use to help our tax professional, our CPAs, EAs, bookkeeper, and other tax professionals who help business owners to reduce their taxes and maybe create a cash flow that they can use to expand their business. Again, thank you very much for allowing me to share this to you. And if you have any question again, you can just email me, curiousfinance.co, or um, comment below. Again, this is another daily dose of knowledge. Have a nice day.